Hi everybody, how you doing? We're going to be covering, well, first off, I hope everybody is safe. Hopefully you've gotten an opportunity to see the first video. Trying something different this time, trying Skype, seeing if maybe the quality might be better, just trying something new. You guys can kind of let me know which way you prefer, the first way or the second way, and we can kind of go from there. I thought today what we would do is kind of focus on Chapter 8. And in looking at the examples that they have within the chapter, I think that's where I should focus today's, lesson. It seemed like the way they did the way they showed the budgets a little confusing, so I thought maybe I could help you understand them a little bit. So I'm going to use the same data that's in the text. So if you have your textbook handy, I'm going to be starting on page 283 and kind of looking at all the information that's in their operating budget. And I'm going to turn on my screen here. Give me a second. So hopefully you can see my screen. And just a couple of notes here. First off, the static budget. You can see that that is the original budget, the budget that the company would kind of create. Like if you're in a calendar year, you would be working on this budget in the fall prior to January. So that's what they mean by the static budget. That's the original budget. And then when you finally do get the actual results, what you do is you kind of create what is known as a flexible budget. And as you can see there, it's an updated static budget to reflect actual volume. So let's say, for example, you anticipated 10,000 direct labor hours, and in reality, you ended up with 11,000 direct labor hours. So you just modify the budget with the actual hours, but you keep everything else the same. So you're just altering the actual units and seeing if you had nailed, the actual volume properly, how would the budget have looked compared to actual, and you can compare static to flexible, that sort of thing. Okay. So notice it also says in green there, it uses original estimates for revenues and expenses with actual volumes. From there, we would do various analyses. One called a variance analysis looks at differences between the two budgets as well as budgets to actual, as I was just describing. There's a variety of budgets: revenue budget, expense budget, operating budget, profit budget. You're going to hear the term pro forma financial statement. Like a pro forma means budgeted. So remember how in the past, whenever we did the headings, we would say for the month ended, and I would always say make sure it's past tense. But when you're doing budgeted financial statements, you would use the word ending, not ended, because it hasn't ended yet, hasn't even started yet. So it's a projected thing. So just FYI there. So when it comes to estimating the volume projection, that's always a challenge, but let's just type this in here. Volume projection, gotta get my stuff out of the way. So volume projection gives managers a starting point for making revenue and cost estimates, kind of give them an idea of how to kind of figure things out for the upcoming period, right? So that's important to know. A couple other things that I want to give you here in terms of some notes. Excuse me. So you're going to be asked to calculate a revenue variance. And the way you calculate a revenue variance is you take your actual revenue and you subtract out your static revenue. So when I'm referring to this, when I say actual revenue, the actual revenue you got during that period, and the static revenue is the one that you had budgeted in the original budget. So whenever you hear the word static, that's representing the original budget. Cost variance. That's your static cost, and you want to subtract out your actual cost. Profit variance. You're going to take your actual profit, and you're going to subtract out your static profit. We can also break these down in greater detail. So let me go horizontally here. So let's put this, I don't know, let's go back to yellow here. So we can take the revenue variance and break it down even further and look at revenue volume. We can also look at revenue price, right? Because you could change the price, and that could alter. You thought you were going to charge $30 a piece and you ended up charging $31 a piece or something along those lines. So we would have something called a revenue volume variance. And in that revenue volume variance, what you would do in that situation is you would take your flexible budget revenue. I'll just call it flex. I need the space. So when I say flex revenue, the revenue taken from the flexible budget, and you're going to subtract out your static budget revenue. Okay. You can also do a revenue price variance. And in that situation, what you would do is you would take your actual revenue and you would subtract out your flexible revenue, flexible budget revenue. So, when it comes to, is it a positive or a negative thing? Obviously, you want your actual revenue to be higher than what you budgeted for. You're happy if your revenue is higher. Okay. So let's put this in yellow. We could do the same breakdown with the cost variance. And we could have a cost volume variance. And that's your static cost minus your flex cost. And then you can also have a cost management variance. And in that situation, you would have flex minus actual. So what's interesting, as in this management variance or cost variance situation, you can actually break this down even further. So let's see if I can do this. Not sure what's the best way here. We could break this down into labor variance. You think this would be easy, but trying to make this thing look right, it's a big challenge. So let's do it this way so you can see it's connected. All right. So we would have something along the lines of a labor variance. And we could actually have a supplies variance. So in other words, what's the stuff that might make up your costs? So we could have our flex labor and subtract out our actual labor. So remember this right up here, flex cost minus actual cost. So we could do it by just labor variance. And with supplies, whoops, what did I do? There we go. I keep grabbing the wrong part. There we go. I think I got it. We could also have, in this situation, your static price, well, actually, flex minus actual again. So flex supplies cost minus your actual. Keep pressing the wrong button here. There we go. So we could actually break down the cost management variance or the management variance into different types of costs. So this is the generic way to do it, but we can also go into a lot more detail and look at just labor. We can also look at supplies. When looking at labor, let me break this down a little bit more. We can go static information minus actual. And we would multiply that by actual labor costs. And that would give us what we call a rate variance. We can also do what is called an efficiency variance. And in that situation, you take your flex hours and you subtract out your actual hours and you multiply that by the static rate. So you can really break this stuff down to figure out exactly where either you went wrong or where you did things correctly. Maybe it's one component, not the whole component. It's kind of like, remember when we did the cash flow statement and we had 3 different reasons why our cash worked a certain way, went up, went down. So by breaking it down into certain categories, you can kind of get a better pulse of where the culprit is if one exists. We can also do something with the supplies variance. And I think I'm going to add an extra little column in here. So with this one, we can go with a price variance and a usage variance. And to do the price variance, what we would have in this situation is your static price minus your actual price, and we would multiply that by actual units. So that's how you can get a price variance to see if if your price situation is what was causing the problem, or maybe it was a usage issue. And we'll call this a usage variance. And for the usage variance, you would take your flex units and you would subtract out your actual. A little step ahead of myself. And then you would multiply this by the static price. So you can see there's a lot of different ways to kind of figure things out here. Okay. So what I thought we would do is go back to page 283, and I've kind of broken down what was on page 283, and I thought what we would do is kind of just slowly, maybe not too slow, but kind of go through Exhibit 83, 84, 85, 86, 87, 88, and 89. Okay, I've rewritten Exhibit 83, and hopefully it's in a way that maybe makes a little bit more sense, but let's kind of go over a couple of things. This example is for Carol's Clinic. Okay, so let's just put up here Carol's Clinics. C-A-R-O-L Clinic. Okay, so these are Carol Clinic volume assumptions. So basically what we're going to do is we're going to create the static budget, and there's basically 4 steps, same 4 steps that they showed in the textbook. All right. The ultimate goal is to be able to do a pro forma income statement. Okay, so this is what the company thinks they're going to have in the following period. So if you notice, there's 2 types of revenues that the company could earn. So they have FSS and they have CAP. I'll explain those in a second. There's also variable costs associated with the FFS and the CAP. Gives you contribution margin. Subtract out your fixed costs, and that will give us either a projected net income or net loss or break even or whatever the case may be. I didn't go into the detail with the date and all that stuff, but if we did, it'd be like for the year ending, for the upcoming year. So a couple of things that we should know about. First off, the 2 different ways that this company can earn revenue. One is for fee for service. That's what FFS stands for. And then it's got capitated population, right? And basically that's another revenue generation that can happen for this particular clinic. So if you look at the fee for service, you'll notice it's got 36,000 projected visits for next year. And they're telling us that we basically average about $25 per visit in revenue, sometimes a little higher, sometimes a little lower. That's what makes it an average. So that's $900,000 in projected revenue from that type of revenue. And then we have this capitated population. And with the capitated population, remember, capitation is like a reimbursement methodology, right? So based on, like a Blue Cross, Blue Shield type of thing. So there's a reimbursement that comes back to the clinic. And they have 360,000 current members. And they're telling us that the per member per month revenue is $3. That's basically going towards the clinic. So that's $1,080,000 in revenue that'll be generated from this member base. And if you notice, I took the $1,080,000, added it to the $900,000, and that's where I got the $1,980,000 in green going across both sections there. That's the same $1,980,000 that I have down here, right here. So I can kind of put this in that same color green. Okay, so that came from step 1. Well, technically step 2. Let me go back up to step 1 and go over a couple of other things here. Where did I get this, 360,000 members? Well, it's 30,000 members per month, which obviously there's 12 months in a year. That's where the 360,000 came from. They have to tell us, or it's actually calculated, but for us, it's something that will be given to us in these problems if we need to go here. So there's about a 15% expected utilization per month per year. So 360,000 members times that 0.15, that equates into about 54,000 visits. So total visits between the capitated population and the fee-for-service population, 36,000 plus 54. That's where I came up with this 90. Okay, so keep that in your back pocket. We may need that number a little bit later. But from a revenue standpoint, we take the 36,000 visits from the fee-for-service and multiplying that by the 25 average dollars that we earn. That's where the 900,000 came from. And now in this particular case, the 360,000 members times the $3 per member per month, $1,080,000. What I did do though was I also figured out a revenue per unit. So I know my revenue per visit is $25 for the fee for service because they gave us that 25. But I then said, okay, well, let's figure out what is our revenue per visit using this capitated population. So I took the $1,080,000, divided it by the 54,000 projected visits, and that's about $20 per visit. So between the two, they're making $45 in revenue per visit between the two types of revenues. Okay, so if you look down in here, notice I have that information, 36,000 times 25, 54,000 times 20. Could I have gotten this 1,080 without figuring out the 20? Yeah, we already did that. We did that here. All right, but once I knew the 54,000, I could also multiply by 20, or I actually backed my way into that 20. But it's good to know, to have it to help me out here in terms of, how we doing from a profit perspective. So if you look at this, let me just skip down to number 4. FFS 25 and the cost is 15. So we're making like a $10 per profit per visit. Whereas in the capitated revenue 20 and 15, that's only a $5 revenue per visit. So interesting to look at it like that. Okay. Total variable costs, you see 1,350,000. So how did I get the 540,000? How did I get the 810? Well, I needed to know my cost, and it's showing up as $15 here. So let's see where that 15 came from. So take a look at my variable costs. So I got variable costs. I also have fixed costs. And in this problem, the fixed costs were projected to be 500,000, and it turns out that there was no alteration to that as you go further into the example. So it saves 500,000 in projection and in actuality as well. All right. The fixed costs are a lot easier to predict, right? Because you kind of know what your mortgage payment is going to be all next year, probably the same as it was this year, unless you have a variable rate. You kind of know what your rent is going to be, ahead of time. It's usually not sprung up on people. So the fixed costs tend to not fluctuate that much. Variable costs, you will notice here that they told us that there was 48,000 medical labor. That's like direct labor in the medical field. So you've heard me use the term direct labor all semester long. I could have easily been referring to it as medical labor. So they gave this to us in the problem. They're expecting 48,000 hours of medical labor, and the cost to us is an average of $25 per hour. So that's $1,200,000. But we're also expecting medical supplies, and I'm sure if you're watching the news with this coronavirus going around, we hear this massive shortage in supplies, particularly masks and other equipment. So you can see that this, was a decent issue before, but now we're in crisis situation. So 100,000 units are what they need or they're projecting. Multiply that by $1.50 per unit, $150,000. So 1,200,000 plus 150 gives me 1,350,000. I divide that by the total 90,000. Remember this 90,000 that I came up with over here? That's the 36,000 visits plus the 54,000 visits gives me the 90. Okay? And 1,350,000 divided by 90, and that's how I came up with this $15. Okay? So take the variable costs, 15 times 36,000. 54,000 times 15, that's where I got the 540 and the 810. Total variable cost 1,350,000. I'm now going to subtract that 1,350,000 from the 1,980,000, and that gives me a contribution margin of 630,000. Subtract out your fixed costs of 500,000, and that gives us our projected net income of 130,000. Okay. So now let's take a look at actual results. And we'll go through this whole step 1, step 2, step 3, step 4 process as well. So this is going to be actual. So when it came to the fee-for-service population, try to keep this as consistent as possible here. They told us at the end of the year, they discovered that there was actually 40,000 visits. Not the 36,000 that they expected. And from a capitated population, 30,000 members times 12. Let's put this here. Okay, so that part being the same, but then the expected utilization ended up being 20%, not 50%. So if you do that math, that comes out to 72,000 visits. Okay, so $42 and $72 gives the total actual visits 90,000. Oh, not 90,000. What am I, crazy? 112,000. Those are the actual visits. So let's take a look at the cost stuff. I'm just going to copy this. Actually, not cost up, but revenue material. So actual revenue. So now what we're going to do is we're going to change that 36,000 to 40,000. And that would bump us up to $960,000. And from a capitated population, we still got 360 times the 3, which is 1,080,000, but now we're going to divide by 72,000 visits, and that'll turn out to be $15 a visit. So if I go and calculate the total actual revenue, instead of 900,000 that I was expecting, I'm now getting 960. Still getting 1,080,000. So that brings up our actual revenue to 2,040,000. So we're looking at actual compared to budgeted. So we're expecting to get 1,980,000 in revenue. We got 2,040,000 in revenue. Favorable. So far, so good from the company's perspective. They brought in more money than they expected. Step 3. This would be actual costs. So when it comes to the medical labor, they were anticipating 48,000 of medical labor, but it sounds like a lot of people came in, a lot of people, maybe some people had to work overtime. The actual hours ended up being 59.9. So 59,900. The actual hourly rate on average ended up being $26 an hour, not $25 an hour. And the actual medical labor turned out to be if you do that multiplication, 1,557,400. From a supplies point of view, they needed a lot more supplies than what they anticipated. Sounds like today's world. And those supplies didn't end up costing $1.50 as projected. They ended up costing about $1.88. That's probably somewhat rounded. And it came out to approximately $234,600. So that 188 is probably like 187 point blah 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 blah. Well, not 187 point, but $1.87 and some extra there, which gave us an actual variable cost of $1,792,000. So right away, look at the difference there. We were expecting to spend $1,350,000. We ended up spending $1,792,000. So that's negative. That's unfavorable. That's over $300,000 of unfavorable or extra cost. And look at our revenue. We weren't $300,000 on the plus side of revenue. So this doesn't bode too well for this company, all right, in terms of what actually happened. Okay, so if we take the cost, which is $1,792,000, and divide that by the total number of visits, which is 112,000, the cost actually ends up being $16 a unit. They told us that the overhead, the plant and equipment, the fixed costs did not change, and I kind of told you that earlier. So total cost went from $1,850,000 to $2,292,000. So $1,850,000 to $2,292,000. So again, doesn't look too good. So let's make this official. So if we break it down by, this is no longer a pro forma income statement, this is the actual income statement. I'll just write actual in here. So now instead of 36,000 visits, we've got 40,000 visits. Instead of 25, it's actually 24. Should be 960,000. Capitated revenue, instead of 54,000 visits, that's 72. And that's at $15 per visit, which is still $1,080,000. Total revenue $2,040,000, which matches what we had. Did I have that number up here somewhere? Oh, there it is right here. Okay, in step 2. And for variable costs, we're going to be using the same FFS quantity, so 40,000. And the same cap visits, which is the 72. So that's going to give us 640 and 1,152,000. The fixed costs remain the same. So notice we had a positive contribution margin, a lot lower than previously. Fixed costs staying at 500,000, we actually have a net loss of 252. So obviously there's some issues going on around here, right? Some projected incorrectly, obviously. So what if we were to do the flex budget? So you can't do the flex until you've actually done the actual. So I'm literally going in the order that this would happen. So the static budget, let's write the word static budget here. Make sure you're clear with that. So the first thing we did was the static budget. Then we just did actual. Now let's do the flex budget. Okay. So with the flex budget, I wonder if I can copy this. Probably would be easier, and then I'll just make my changes accordingly. So this will end up being our flex budget. And notice what I'm putting in there at the top, flexible budget, Carroll Clinic volume assumptions with actual volume. So what we're going to do now is we're going to basically say, well, what if we use actual visits, not original guessing visits? So basically, this will end up being the same. All right, so 40,000. This will end up being 0.20. Just give me a second to make my little modifications. So 360 times 0.20, that's going to give us 72,000. And our total is going to be 112. And that's expected because we're keeping, I should say, the actual volume. So remember, the actual volume was 40,000 visits and 72,000 visits, 112. So when we go into this step 2, do you remember how I never changed this, by the way? So you may have been wondering, hey, that math doesn't work out. So back in the actual results, the revenue was averaging $24 a visit, not $25 as we anticipated. So if we go back to the original, 36,000 times expecting $25 revenue per visit. We ended up with 40,000 visits, but the average revenue only ended up being 24. Okay? So now what we're going to do is, for the flex budget, we're going to use the old $25 and the actual visits. So the flex budget kind of does a little bit of actual and a little bit of static budget mixed together. So now we have 40,000 times 25. So in other words, we're saying, what if we knew the actual number of visits? What if we had nailed that? Okay, what would our budget answer have been? And in that case, they would have projected for $1 million. So we would have $1 million down here. I didn't realize I had that mistake in there. Let me fix it here as well. This should be plus. And this should be plus. So now when we add $1 million to $1,080,000, we get $2,080,000. Okay, so under the static budget, $1,980,000. Under the flex budget, $2,080,000. And in reality, $2,040,000 is what we got. So the flex budget tends to be a little bit closer to reality because you're now using some actual information in your calculations. From a cost perspective, this is where your book was not very clear, but I will do my best to kind of clean this up a little bit. So the medical labor ended up being about $59,733. I had to do a lot of backtracking to figure that out. Total cost $1,493,325. The supplies, in reality, $124,450. Total of about $186,675. Those two values on my part were kind of, I had to backtrack to get these. They didn't do a very good job of supplying us with that information. So I was able to come up with this for sure, and then I kind of had to back my way into figuring out what those other things were, because the book did a poor job of showing that. But anyways, so we end up with a cost of $1,680,000 and $500,000 still in fixed costs. So that's going to give us total flex budgeted costs. Let me go back here and look at actual for this one. And that ends up being $2,180,000. Okay, so if I look at my income statement with flex, we'll call it a flex income statement. Got to make a couple of little modifications. Instead of 36,000 visits, we're using 40 at 25 for a total of $1 million. And instead of 54,000 per cap revenue, we're using 72,000. But 72 at 15, not at 20. So that gives us $1,080,000 again. Total revenue $2,080,000. Variable costs, we're going to keep the visits the same. So we got 40 and 72. So 600,000 and 1,080,000. And now with the flex budget, we're off by $100,000. So we still want to figure out where we're off by. So there's a lot of stuff there. I'm not sure if I simplified what they showed in the book or not, maybe a little bit. It's just kind of weird the way they had it set up. But let's go through and do some of the variances here. Okay. So it might be in our best interest to simplify all of this. And they did a really good job of that on page 289. So if you can have page 289 open, we can do some variance analysis ourselves. So if we want to do the revenue variance, I don't know if you remember, but I gave you this before. Here's the revenue variance, all this stuff. This is basically what we're going to do right now. All of these variances. So I'm going to copy these. So with the revenue variance, there we go. Actual revenue minus static revenue. So I'm literally, if you're looking at page 289, look at your actual revenue. Actual results was $2,040,000. And we're going to subtract out the static revenue, $1,980,000. And that gives us $60,000. So do you think this $60,000 is a favorable or unfavorable variance? And I would conclude that it's favorable. Right? We made more revenue than we expected. If we look at revenue volume variance, that's your flex revenue minus your static revenue. $2,080,000 minus $1,980,000. That's going to give us $100,000 difference. And being a positive number. And again, your actual is higher than your budget, favorable. If you look at your revenue price variance, take your actual revenue and subtract out your flex. We got $2,040,000. And subtract out your $2,080,000. This is going to give us a negative value of $40,000, and we would conclude this to be unfavorable. So if you get a positive answer, call it favorable. If you get a negative answer, call it unfavorable. Let's look at the cost variance stuff now. So let's take a look at the cost volume variance first. We're going to go static minus your flex, looking at the costs. So we're going to keep the fixed out of it, okay? And that's because the fixed never changed. So we were projecting 500, it stayed 500. So all our answers could reflect the fixed, but it's not going to make a difference math-wise, because they would both be up by 500, both be, so we'll just ignore that. So we're really just analyzing the variable costs here. So from a cost variance perspective, static cost minus actual cost. So 1,350,000. And subtract out your actual costs. We know we're going to be unfavorable in most of these answers, just based on the nature of what we've already seen, because we ended up with a loss answer. And major unfavorable result here, negative 442,000. From a cost volume variance perspective, static cost 1,350,000 minus your flex cost of 1,680,000. That gave us an unfavorable result of 330,000. And if we look at cost management variance, flex cost minus actual costs, 1,680,000 minus 1,792,000. That would give us 112,000 unfavorable. Okay, I'm going to move these guys down, even though I didn't like what I was doing before. So hang on just 1 second. I keep grabbing. It means my mouse battery is fading away here. Whenever that happens, I know that. Okay. Okay, much better. So, analyzing this cost management variance in more detail, let's look at labor, let's look at supplies. Maybe we can get a better idea of where the culprit is. Is it the labor issue that messed us up? Is it the supplies that really messed us up? So if we look at the labor variance to begin with, right, we have, well, if you remember, we have this 112 answer. And of that 112, some of it is going to be labor variance and some of it's going to be supplies variance. So from a labor variance point of view, your flex labor let's see, will end up being, let's see if I can break this down for you, negative 64,075, and the supplies variance will end up being negative 47,925. Let me just double check this math here real quick. 64075 plus 47,925. Yeah, that's my 112. So I got that by taking my flex labor minus my actual labor, and my supplies variance, my flex supplies cost minus my actual supplies cost. Okay. To get my rate variance, in other words, if I broke this $64,000 down, let's see if we can attribute it to rate or we can attribute it to efficiency. So if you look at the rate, it says static minus actual. So we've got 25, use parentheses here, 25 minus the 26, right? The hourly costs. We are expecting to pay 25. We ended up paying 26. And then minus the actual labor costs, which were 59.9. That gives me a rate variance of negative 59,900. So of this negative 64,000, 59.9 of it has to do with rate variance. So that $25 to $26 an hour made a huge difference, or per visit, excuse me. Okay. If we look at the efficiency variance, the flex hours, 59,733 minus 59.9 multiplied by the $25 an hour. That gave me a negative value of 4,175. Whoops, I did it again with the mouse. So it's very clear when breaking down the labor variance that the biggest culprit, the main reason for this $64,000 loss when it came to labor was that visit, that hour, that dollar amount per visit. 25 versus 26 turned out to be huge. If you look at the price variance for the supplies, so if we look at the, for this one, let's see if I can get more color in here. We've got $1.50 versus $1.88. Let me use parentheses. And multiplying that by the actual units, 124,800, $47,000, a little bit over 47,000 that we really weren't anticipating. So of this 47,925, 47,400 could be attributed to the price, the change in price, $1.50 to $1.88. So I don't even need to do the math for this one, but I'll just put the end result, and that's a negative $525. So you can see where the issues actually are. Let's see if there's anything else. I think there was one more formula, profit variance. Yeah, let's just do that one, then we'll call it a day. So for the profit variance, take your actual profit minus your static profit. So actual profit ended up being a negative, if you recall, $252,000. And we were expecting a static profit of $130,000. So overall, we ended up with a negative $382,000 profit variance. So we were expecting 130. We were off by 252. So in reality, we're off by 382. Crazy. Okay. Well, this was tough in the sense that, I wanted to redo the example that was throughout the chapter, and hopefully the chapter example makes a little bit more sense. I hope it does. What I would do for homework, you're going to find the homework way easier than this, I think, because you don't have to always set up the whole budget, unless, of course, you want to try problem number 4. If you want to try problem number 4, it kind of has you go through and redo one of these budgets with some new information, which may not be a bad idea to do. But I would say for homework on page 296 to 298, questions 8.1, 8.2, 8.3, and if you want to, 8.4. Okay? And a lot of these, the numbers are going to be given, and you just have to kind of do the variance stuff that I'm doing here. But it would be good practice if you actually kind of created a budget. All right? That's it. So once I hear from you, make sure you text me and say you've watched this next video, and probably next Sunday or Monday, I will upload our next test. Okay? The test will be on chapters 7 and 8. There will be no video next week. So instead of a video, you'll have the test. So I'll upload the test onto Blackboard. You'll have a choice like you've been used to. Probably do 4 out of whatever number I give you. They'll be worth 25 points each. You pick whatever you want to do, and then you email it back to me. So there's no place on Blackboard where you upload it, so you're going to email it. Okay? If you have any questions, you can ask when you guys text me, but I think it should be fairly straightforward, and I will also upload these notes onto Blackboard so that you've got a copy of them. Okay? All right, you guys, I hope you're doing okay, and let me know how you liked this presentation better than the other one in terms of the visual. Okay? All right. Have a good one. Bye-bye.